Hi, everyone, and welcome to Chapter 5, Practice. So in this presentation, we're going to be looking at various problems at the end of the chapter, starting with problem 520A, which is on page, I'm getting there, 231. Nope, I'm wrong. Yep, 231, bottom of the page. So in this first practice problem, we're looking at Northwood Company. They manufacture basketballs. The company has a ball that sells for $25 at present. The ball is manufactured in a small plant that relies heavily on direct labor workers. Thus, variable expenses are high, totaling $15 per ball, of which 60% is direct labor costs. Last year, the company sold 30,000 of these balls with the following results. So 30,000 times $25 a ball, 750,000. The variable expenses of $15 times 30,000 balls would be 450,000, leading to a contribution margin of 300,000. Fixed expenses of 210. Net operating income then would be 90. So, to demonstrate some of the tools we learned in this chapter, the first requirement is to compute the contribution margin ratio and the break-even point in balls. So if we take selling price and assign a 100% figure to that, the contribution margin percentage would be found, or ratio would be found, by taking the contribution margin of 10 and dividing that by the selling price of 25, giving us 40%. Then you saw in your chapter, you can then determine break-even by using an equation where profit equals unit contribution margin times quantity minus fixed expenses. So if our profit needs to be 0 and our unit contribution margin is 10, how many balls do we need to sell to cover our fixed expenses of 210,000? So you would solve algebraically, and you can see the quantity equals 21,000 balls. You can also compute this by taking fixed expenses and dividing it by the unit contribution margin, and you get automatically to the 21,000 balls. Now in part B of 1, the degree of operating leverage at last year's sales level. Now remember, the degree of operating leverage is how much more was sold than break even. So take your contribution margin of 300,000 from last year, divide it by your net operating income of 90,000, and it's 3.33. So practicing some of this information we've learned. Let's look at number 2. Due to an increase in labor rates, the company estimates that variable expenses will increase by $3 per ball next year. If this change takes place and the selling price remains constant at 25, what will be the new contribution margin ratio and break-even point in balls? So selling price remains at 25, but now variable expenses will increase to $18 per ball, leaving us with a contribution margin of $7 per ball. Take the $7 per ball divided by the $25 selling price, the contribution margin ratio will be 28%. Now, if we want to determine the number of balls, we can use the same types of formulas we saw before. You could either use the formula or the equation, whichever you prefer. I myself like the quick and easy route. How much are our fixed expenses that we need to make? Because you have to make at least that much in contribution margin, 210,000. How much do we earn in contribution margin for each ball? $7 under this scenario. So the amount would be 30,000 balls. You could also use profit equals unit contribution margin times quantity minus fixed expenses. And you would still come up to 30,000 balls. Just two different approaches to get to the same answer. In part 3, refer to that data we just looked at. If the expected change in variable expenses takes place, how many balls will have to be sold next year to earn the same net operating income? 90,000. So now In part 2, we looked at how much do we have to sell to break even. Now we have to see how much do we have to sell to reach a $90,000 profit. So you can use your equation, profit equals unit contribution margin of $7 times quantity minus fixed expenses. But now you have to populate 90,000 for the profit. Solving algebraically, 42,857. Another approach is to take the target profit plus the fixed expenses. So that's the total contribution margin you must make. If your contribution margin per unit is $7, then you must sell 42,857 balls to reach a $90,000 profit. So sales will have to increase 12,857 balls to earn the same amount of net operating income as last year. In part 4, refer again to that data in 2. The president feels that the company must raise the selling price of its basketballs. If Northwood Company wants to maintain the same contribution margin ratio as last year, what selling price per ball must it charge next year to cover the increased labor costs? So, price equals $18, so selling price equals the variable cost plus 40% of selling price, which is the contribution margin from the prior year. If you remember, in the very first part, that was the contribution margin ratio. So we need our selling price to equal $18 plus 40% of the selling price. So solving algebraically, the price would need to be $30, and you can verify that. If the price is 30, variable expenses are 18, our contribution margin would then increase to $12, which is 40% of the $30. 12 over 30 would give you the 40%. So the price of the basketball would have to increase $5. Back to part 5. Refer to the original data. The company is discussing the construction of a new automated manufacturing plant. The new plant would slash variable expenses per ball by 40%, but it would cause fixed expenses to double. If the new plant is built, what would be the company's new contribution margin ratio and new break-even point in sales? So now we have to account for these new variables. Variable expenses, refer to the original data. Okay, what are they doing to us there? Let me take a look. Oh, okay. I thought they were slashing in half. They're not. Variable expenses would decrease 40%. Slash them by 40%. So the original is $15. We have to subtract 40% of $15, which would be $6. So the new variable cost per ball would be $9 under these circumstances. Selling price $25, new contribution margin $16. So how many of these balls would we have to sell to reach the break even, which is now doubled the fixed expenses? They went from $210,000 to $420,000. So profit would be 0 equals $16 per unit times the quantity. So we're solving for the quantity minus the new fixed expenses of $420,000. So solving for Q, the company would have to sell 26,250 balls. That's using the equation. You could also use the formula. Take the new fixed expense amount of $420,000 divided by the new unit contribution margin of 16, and you'll get the same result. They'll have to sell 26,250 balls if they decide to build this new plant. So you're seeing how these equations and formulas are used to help answer questions, managerial questions about the company's product, and in this case, should they build a new plant? Now we're going to refer back to 5. in part 6, if the new plant is built, how many balls will have to be sold next year to earn the same net operating income? Well, just like before, instead of having a zero profit, we're now going to show the $90,000 profit plus the fixed expenses. So that is the total dollar amount of contribution margin that must be made in order to reach a $90,000 profit. Divide that by your new contribution margin per ball. The company will need to sell 31,875 balls. So that's using the formula. If you use the equation, profit equals unit contribution margin of 16 times quantity minus 420,000 to reach a $90,000 profit. 510,000 divided by 16 would yield the same number of balls. So it's just a different approach to getting the same answer. In part B, assume the new plant is built and next year the company manufactures and sells 30,000. Prepare a contribution format income statement and compute the degree of operating leverage. So we would take the sales of 30,000 balls times $25, 750,000. The variable expenses would be 30,000 balls times the new the new variable cost of $9 per ball. Contribution margin would then be at 480,000. Subtract the new fixed expenses of 420,000. The net operating income would be 60,000. Contribution margin divided by net operating income gives us a degree of operating leverage of 8. Okay? And then finally, in part C, it says, if you were a member of top management, would you have been in favor of constructing the new plant and why? So this problem illustrates the difficulty faced by some companies. When variable labor costs increase, it is often difficult to pass these cost increases along to customers in the form of higher prices. Thus, companies are forced to automate, resulting in higher operating leverage, often a higher break-even point, and greater risk for the company. So there's no clear answer as to whether one should have been in favor of constructing it or not. There's nothing indicative here. It's kind of like, what should we do? Okay, so that is a great problem looking at all of the various items we had in this chapter. The next one we're going to look at is 521A. Now in 521A, there is Gold Star Rice Ltd. of Thailand exports the Thai rice throughout Asia. The company grows 3 varieties of rice: fragrant, white, and Lunzane. Budget sales by product and in total for the coming month are shown here. So they show you the percentage of sales of each brand of rice, type of rice, the total sales, the total variable expenses associated with each, the contribution margin of each, and then the fixed expenses for the company as a whole. And it's showing that based on this information, there's a loss of $59,280. They compute their dollar sales to break even to be $702,000. As shown by these data, net operating income is budgeted at $30,720 for the month and break-even sales at $702,000. Assume that actual sales for the month are $750,000, as we see above. Actual sales by product are white 300, fragrant 180, and Lunzane at 270. Now, I'm sorry, that was the amount that's given in the problem, right? Prepare a contribution format income statement for the month based on the actual sales data. So I'm sorry, the information in the book is different than what we see in our answer key, right? And that only makes sense. Now, the sales are 300,000. 72% of sales are for variable expenses. So multiply 72% times 300,000, 216,000 are the variable expenses. If you subtract the 300 from 216, you get $84,000. So we're going to use these ratios that we calculate for variable expenses and contribution margin ratio to calculate the amount of variable expenses and the contribution margin for each item, each type of rice. If the sales are 180 for fragrant, then 20% of the sales would be variable expenses. So 20% of 180,000 be 36,000. So contribution margin would end up being 144,000. And then finally, on the Lunzane, if sales end up being 270,000, 40% of sales is for variable expenses, 108,000. Subtract that from the sales to get contribution margin of 162,000. So if that's how the actual sales occur, the contribution margin total will be 390,000, or 52%. 390 divided by 750,000, okay, 52%. Now, the fixed expenses stay constant, 449,280. So if this is the result, there will end up being a net operating loss of 59,280. So in part 2, they say, well, what would be the break-even point in dollar sales for the month based on your actual data? Well, fixed expenses are 449,280. Contribution margin ratio overall is 52%. So overall sales should be 864,000. Right now, they're at 750,000 if we want a zero profit. Considering the fact that the company met its $750,000 sales budget for the month, the president is shocked at the results shown on your income statement as one above. Prepare a memo for the president explaining why both the operating results and the break-even point in dollar sales are different from what was budgeted. Well, simply put, although the company met its sales budget, the mix of products changed substantially from that budget. The company was supposed to sell 150,000 in white. They sold 300,000. They were supposed to sell 390,000 of fragrant, which has a contribution margin of 80%. They only sold 180,000. And the Lunzane, although it was a higher amount sold than budgeted, the contribution margin is much less. So as shown by these data, sales shifts away from fragrant rice, which provides our greatest contribution per dollar of sales, and shifts towards white rice, our greatest, which provides our least contribution per dollar of sales. Although the company met its budgeted sales, the mix of the sales among the different types of rice still allowed for us to meet and have a loss, because the mix of sales less the variable expenses for each did not allow for our contribution margin to cover the fixed expenses. Okay, so let's take a look at 522. Due to erratic sales of its sole product, a high-capacity battery for laptop computers, PEM Inc. has been experiencing difficulty for some time. The company's contribution format income statement for the most recent month is given below. So they sell this battery at $30 each. The variable expenses are a total of $409,500. So if you take $409,500 divided by the 19,500 units, variable costs are $21 each, which leads to a $9 per unit contribution margin, or $175,500 in total. If we want to find the contribution margin ratio, take the $9 per unit divided by the sales per unit of 30, it's 30%. So 30% of the sales remains as contribution margin. Now, in part 1, compute the company's contribution margin ratio, which we just did, and its break-even point in both unit sales and dollar sales. So we've seen unit sales a couple times. Take the fixed expenses divided by your unit contribution margin, the actual dollars. So 180,000 is the amount of fixed expenses. If we make $9 per battery, divide that, you have to sell 20,000 units or batteries to break even. How much is that in dollars? Well, instead of using the contribution margin dollar amount, use the contribution margin ratio percentage divide that into your fixed expenses, and it gives you the amount of dollars you have to sell, which would be the same as 20,000 units times the $30 sales price. In part 2, the president believes that a 16,000 increase in the monthly advertising budget combined with an intensified effort by the sales staff will result in an $80,000 increase in monthly sales. If the president is right, what will be the effect on the company's monthly net operating income or loss? Now, it says use the incremental approach. So in the incremental contribution margin, we want to say, well, how much does he want to increase sales? 80,000. How much is that? Contribution margin-wise, well, those $80,000 in sales will add $24,000 to the contribution margin. If we increase advertising cost by $16,000, the monthly operating income increase will be $8,000. Since the company is now showing a loss of $4,500 a month, they would now show a profit of $3,500 because of that additional $8,000 in net operating income. There we go. Okay, so just showing you how we use these items to answer questions. Refer to the original data in number 3. The sales manager is convinced that a 10% reduction in selling price from $30, we're going to decrease it 10%, combined with an increase of $60,000 in monthly advertising budget will double unit sales. What will the new contribution format income statement look like if these changes are adopted? Well, first of all, he wants to take, we're still selling 39,000 units. Okay, and they say refer to the original data. Well, if you look up here, the original data said, whoops, what are we doing here? Let's see. One second. I missed something. Oh, we'll double unit sales. So originally the unit sales were 19,500. So if they believe it will double unit sales, the new sales will be 39,000 batteries or units. The new selling price will be 10% less than the original. Original was $30. 10% of $30 is $3. So now the selling price would drop to $27, which would result in $1,053,000 in sales. The variable expenses will be $39,000 times $21 per unit, that stays the same, or $819,000 in total. If you subtract that, you'll get a contribution margin of $234,000. Now remember, he wants to change the fixed costs, add an additional $60,000 to the advertising. So the new fixed cost would be $240,000. This would result actually in a net operating loss of $6,000. So it's not going to be successful. And you could prove it through these computations. In part 4, refer to the original data. The marketing department thinks that a fancy new package for the laptop computer battery would help sales. The new package would increase cost by 75 cents per unit. So now we're increasing variable costs or expenses. Assume no other changes. How many units would be sold each month to earn a profit of $9,750? So now what's happening? Well, our contribution margin per unit is going to change from $9 to $8.25. $30 selling price minus a new variable expense of $21.75. You need to add that 75 cents for the new packaging. So if our contribution margin per unit is at $8.25, want to make a $97.50 profit and have fixed costs of $180,000, doing the algebra, you would have to produce or sell 23,000 units. You can also do this computation as below. Take the target profit of $97.50 plus the fixed cost of $180. That's the total contribution margin that must be made. If the contribution margin per unit is now at $8.25, divide that in, 23,000 units is how many you have to sell. Okay, and our final area is on number 5, refer to the original data. Now they're saying by automating, the company could reduce variable expenses by $3 per unit. However, fixed expenses would increase by $72,000 each month. Now they want us to compute the new contribution margin ratio and break even in both sales and units and dollars. So our sales would be at $30. Our variable expenses would decrease to $18 per unit. They were at 21, now they're at 18. So our new contribution margin is 12. 12 divided by 30 would give us a 40% contribution margin. If we want to know how many units we have to sell to cover our fixed expenses, which would now increase by an additional 72,000. So the original was 180 plus the 72,000. Divide that by our new contribution margin per unit, 21,000 units. If we want to know the dollar amount of the sales, you could take the 21,000 times $30, or take your fixed expenses plus the 180 plus the 72,000 and divide that by your contribution margin ratio, which is now computed to be 40% from up above here. And the dollar amount of sales would be $630,000 to break even under this scenario. In part B, assume that the company expects to sell 26,000 units next month. Prepare 2 contribution format income statements, one assuming that operations are not automated and one assuming that they are. So if they are not automated, 26,000 times $30 would be your sales. Variable expenses would be 26,000 times $21 or $546. Your contribution margin would then be at 234,000. Fixed cost 180. Net operating income is 54,000. Under the automated scenario presented in part 5, total sales would now be 780,000, still a selling price of $30 each. But now variable expenses are $18 per unit, so 26,000 times $18 would be at 468, leading you to a contribution margin of 312,000. Remember, the new fixed expenses under automated would increase by 72,000 up to 252,000. Subtract that from your contribution margin, the net operating income would be at $60,000. So you would have more of a profit under the automated system. And then finally in part C, would you recommend that the company automate its operations? So whether or not the company should automate its operations depends on how much risk the company is willing to take on and prospects for future sales. The proposed changes would increase the company's fixed costs and its break-even point. However, the changes would also increase the company's contribution margin ratio. The higher CM ratio means that once the break-even point is reached, profits will increase more rapidly. Okay, and you could read through the rest of that. So 3 practice problems, all utilizing the information discussed on cost, volume, profit relationships, the formulas, and how we use these items to make decisions about products or activities within the company. So please post any discussion or any questions or discussions you may have to the discussion board.